Hi and welcome to another episode of World of Oil Derivatives. I'm Greg Newman, the CEO of Onyx Capital Group, and I'm joined with Audrey and Ehsan from the research team at Onyx. Let's go here, a quick reminder before we get started. We are on YouTube as well. I know a lot of people consume what we're listening to on Spotify and Apple Podcasts, but we are been filming this in person. Sometimes we're putting up graphics and things like that, so it's worth a listen if you have YouTube. So let's just get straight into it then. We just need a summary, I guess. Who wants to start? Ehsan, do you want to go through like what's happened this week and some of the major stuff?
Yeah. In terms of the flat price action, seems like Brent futures is stabilizing around 75. And after a massive, exodus of like people getting burned or the length in the market, and now the market is correcting and resetting in terms of positioning. Also, there was a revision by the IEA for their demand forecast this year. They increased that a little bit.
Increase the demand.
Increased the demand outlook by 200 kb per day for the rest of the year.
Based
on Chinese recovery. But again, it's
same.
Yeah, same stuff that like have been talked about like over the last, I'd say like 6 months. So there's that, and there's also the US dollar, which has found like the US dollar has been very, very strong.
Yeah.
And that has affected the commodities market, especially like gold and silver. They took a hit based off this strength. But the interesting thing in the US dollar positioning, based on the CFTC data that came out, was that the market was massively positioned short, and people are just betting.
I guess following the news of the debt ceiling, yeah?
So this is in line with that. But like in terms of like positioning, people have been like always, over the last couple of months, they've been positioning short. But now with this strength, some of those shorts are just like closing out, stopping out, which is giving more strength to the dollar index. But the effect of that has not really been materialized in the oil market yet. As in the prices over the last 2 weeks have been like, again, resetting. So that has not really hit the oil market yet, I would say. A little bit about the North Sea market as well. The physical market in the North Sea. It's a period of like low liquidity, and it seems like the performance in the physical market is pretty weak. Since TI Midland was included into the benchmark, there's a lot more cargoes available, and then there was like trade houses offering 40s aggressively, which translated into weaker physical market.
Yeah, it's weird. Like in Singapore this week, and talking to traders last 10 days, like the sell-off to 75 in Brent has seemingly made people even more enthusiastic about this second half demand outlook. And it's just, that's all everyone talks about. It just really emphasizes how the market just loves a narrative. So, we have to look at the data to be clear about how balanced it is, but it does seem that, the market's reset essentially at 75. So what does it mean at 75 as a different market? And there's more upside, I guess, for those who are bullish. And so even though there was this washout, like you were saying, I think trade houses especially are kind of piling in long. That would be my guess and the feel of things. And I guess it's all based on that second half demand. So yeah, you're right to bring that up. And then we've got the OPEC meeting coming up as well, right?
Yes. Just one thing before we get to talk about OPEC, maybe we can talk about the gasoline strength in Europe specifically.
Yeah.
That's one thing that was quite interesting. A lot of like ARB selling and moving products into US, like really strengthened the EBOB again. So that's one thing that's quite interesting. And
this is for which contracts?
EBOB cracks.
And those in like Q3 or?
Generally like from the front month, and that has kind of lifted the rest of the curve too.
Yeah.
But one thing that's like repeating pattern from last year is, this strength in gasoline and weakness in naphtha has put the gas nap levels really high. Okay. Again, like mechanically, but there's there doesn't seem to be like any lid on the prices, as in like the sell side flows, to control these rallies in the gas nap levels. But yeah, maybe.
No, I was just going to dissect some of the things you said, because there are quite a few things going on there. I mean, so it's basically the kind of fundamental physically led information versus the macro story. At the very least, there's a lot more going on than there was even last week. It was getting almost kind of boring. So yeah, it's heating up again. So the IEA come out with demand forecasts, re-emphasize that. That's what everyone's talking about. That's leading to some long positions. The second half, what you're saying, like the gasoline strength, we talked about that a couple podcasts ago, about that probably being the leading bit of information about actual positioning in second half. Like there's not really much. Like if you break it all down, people might be long the Brent futures or starting to be bullish in their sentiment on Brent crude futures, but dissecting all the different areas of oil, they all kind of point the other way, apart from maybe gasoline, where we're seeing a lot of Asian fixtures being booked, and Europe now, you're saying, into US. So a lot of the US strength for the kind of classic summer gasoline demand is probably a bit, well, not the majority because of the China story, but it seemed like a big part of this second half demand story. Yeah. And that does help with the US coming out of the debt ceiling situation, right? If you're bullish the US economy, then that's going to filter into more US gasoline demand, which can filter into the second half demand story and all the rest of it. Yeah. So that's maybe like a bit of contagion there.
There's a bit of evidence that like, people are positioning for this,
which we weren't seeing before as well.
Yeah, exactly. And also I think it was very well reflected in the refinery margins back then too, because like, you had the weakness in gas oil, you had the weakness in gasoline, and like European refinery margins came under a lot of pressure. But now we're back into, around, for M1 refinery margins in Europe, you're around $7.
That's a pretty decent pickup, isn't it?
Yeah, it's like in the last. This is off the back of that really strong performance of EBOB that has really
that's driving the margin up.
Yeah, okay. Exactly, okay. And also a little bit of gas oil too. I think Audrey, you mentioned about the gas oil market and the distillates market picking up a little bit.
Yeah. No, this week it's picked up a little bit, and kind of what's driving that. I mean, obviously we saw in the CFTC earlier in the week that shorts actually stopped out of positions, for the first time after building positions for the previous 4 weeks up to this point. And, we saw a little bit more length being added. But one interesting news headline that came out that, maybe this was playing on sentiment a little bit is that Josep Borrell, so he is the EU foreign minister, so he's kind of come out and he's urging, India to crack down on fuels made with Russian oil. And we spoke about this, in our earlier podcast, is that, the market seemed like it was getting really lazily short in gas oil. But people weren't really factoring in, what if we do start clamping down on those Russian flows that are getting into the EU? And this is the first kind of signs that, this is going to be the case. Like people are starting to look at this, and, obviously he hasn't mentioned any, sanctions that are going to be happening as of yet, but this is finally now something that we're beginning to look at. I guess everyone was kind of a little bit maybe afraid to actually, address the elephant in the room that, okay, we know Russian flows are getting in, but let's just leave it a sec. Let's not mess with this market anymore. Let's just see where it goes. And now that prices, have come off quite significantly from where they were earlier in the year, it's like, okay, well, now we know there's this issue. We don't want Russia benefiting from their war in Ukraine. We want to hit them where it hurts, in their pockets. And this is an issue we know is happening, and we need to sort it. The market hasn't ripped exactly, but it has been, stronger than we've seen in recent weeks. And we have seen bills, and it's been kind of holding steady into the end of the week. And again, we know that market is overall positioned really, really short in those futures. And we've talked about this,
gas oil, you mean?
In gas oil futures. Yeah. So, if they do start moving up, it really is primed for a rip if they were to, implement any sanctions or even chatter about sanctions in the future.
Our distillate trader like Leger in Singapore, he was saying that this week. It's like the kind of bear market rallies, it looks like, in the gas oil cracks. Like it kind of, when everyone's short, you tend to get these like move ups that, just drifts higher, and so starting to see that. So I see your logic like 100%. But yeah, the rebound in the refinery margins is quite a big deal because, yeah, everything you guys are saying, it's finally some new news to spur at least some crude demand.
Yeah.
And like Ehsan was saying, like the North Sea, the dated Brent market is, yeah, I mean, it's looking on balance weaker, but that's not, as you said, liquidity is low. So it's not to say if there's a new impetus, we can actually drive. That's the essence of what we're saying, right? So if you're short gas oil and kind of lazily, like nothing really in other contracts, then if some new news comes in that can stimulate bullish sentiment, it will actually have quite a big impact on where we are. So maybe people would be right to be kind of starting to feel bullish again. I can see the logic in that.
I think it was kind of a similar thing that happened in EBOB too, as in like people were positioning short, you know, oh, this is too high. let's get spec short in EBOB crack. You know, now the news of refinery strikes, etc., is out of the window, and let's get short. But then like the market rallied, and then like they had to exit their positions, which really strengthened the levels for EBOB. And similar thing as you said, like it can happen to the gas oil market, and we're seeing like small evidence of that kind of building up at the moment.
I think like when you prop up a market like I felt we were a few months ago, and then we had the OPEC cut and a lot of people expecting bullish and it wasn't, and that kind of thing. When you have a reset like this, like you get out of all like a lot of the open interest and you can just let the market settle. If you do genuinely believe the market's fundamentally strong, then you should kind of want this washout, because then it can reset and you can let the hedging flow come in that should outweigh the sell side hedging flow if it's fundamentally bullish, and that will start to have a real impact. So it seems like that's kind of the case. And the other thing that was interesting looking at the stocks, so we had a really big build right on Wednesday in the EIA.
Yeah, 5
crude.
million in crude.
Over 5 million. Yeah.
And it was expected way less.
Yeah.
So the market rallied on that news. At least maybe not instantaneously, but within the next day.
It was a green candle, yes.
Yeah, so that's really bullish, right? You have very bearish sentiment. Sorry, very bearish headline, very bearish fundamental information, and yet the market rallies. So it probably was just like the reverse of the OPEC story, right? They make the cut and the oil traders and majors use it as a chance to sell out of their length. You could argue it's probably the same this time round. The guys who were short,
the other way around, yeah,
using this as using bearish information in the market to take profit because you expect sell side flows. So who knows? But yeah, I kind of agree. Like the general picture is like, because of the refinery margins rallying in particular, and then some more information like the US macro story. Yeah, it's starting to feel like there are a lot of buying flows could enter and cause a rally. But on the flip, what's the flip side? I mean,
gotta be demand.
As in the demand story doesn't filter out.
Yeah, I mean, in distillates, it's just not there yet fully.
Yeah,
that's the main thing there. That's
recession fears.
Exactly.
The industries are like really ramping up.
Well, the next OPEC meeting.
June 4th, yeah.
Right, June 4th. So the expectation, you've just gone, you want to talk about?
Yeah, so I think what we had was, I think we had the internal poll.
On this, on LinkedIn.
Internal poll?
No, an internal one. Sorry, as in like an Onyx poll. Going around like every desk and asking.
No, this was interesting. So 65% of participants believe that OPEC are gonna cut further. So obviously you've got like Iraq coming out and saying, we don't think that they're gonna do this, that they're not gonna cut again. And then you have, people just not believing this anymore, obviously from those numbers that we're seeing, which is kind of interesting. I mean, if they cut again, but then you've got other countries like Libya talking about how their production is going to reach like a decade high by the end of the year. They're going to try and hit like 1.3 million barrels per day by the end of the year. So, who's to believe here? Do we believe like Iraq that no, they're definitely not going to cut, and Libya telling us that, they're going to ramp up production, or, clearly the market just doesn't trust that this is going to be the case with, much more than half the people believing there's going to be a cut.
Well, when Iraq come out, like it's an important point, right? Because the last time we saw this was the UAE delegates doing the same thing, saying like essentially suggesting they weren't really aligned with the OPEC strategy. And so that's Iraq saying now, like we literally can't. There will be no additional reduction for Iraq. We cannot reduce it any further. That's what he said. So I think that's a signal, right, to the group, which is like that we've already done this to like, again and again and again. This is like a whatever it is, the third cut in such a short space of time, and it's not having the desired effect. Well, it didn't have the desired effect. I don't think people are going to want to do it any further. Ironically, it's quite a good time to do it, because if you catch the market unawares again, which is what we're saying, right, is in like you're starting to get the gas oil rallies, you're starting to get refining margin rallies, it could transpire into real buying flows. So an additional cut maybe would have the desired impact that they want from last time. But why mess with it if it looks fundamentally sound?
Yeah, that's the, I think like they've tried to like impose control over the market a few times, and they've been burnt a few times. So as you said, if the outlook in the market is looking good and everything is going in the right direction, why touch it and why change things? Because like it might become like another liquidity opportunity for people to readjust their books, and you know, to take on profit on their hedges, etc. So I think like leaving the market the way it is reasonable, and you know, there's definitely more bets coming in, especially in the product side of things. In the fuel market, you know, VLS have had a really strong week this week, especially in the East. You know, that is helping the refinery margins too. There's a few factors, you know, really helping with the margins, and like the market is looking pretty healthy, I'd say.
Well, the macro story is interesting because I think there's been some, like the US essentially, the story is quite good there, and that encourages a lot of financial traders trade WTI off the back of macro stories, right? But actually China is the opposite in the sense that it's been quite underperforming in terms of headlines, right? The manufacturing index, things like that, has been disappointing. So with this big demand story that literally everyone seems to be focusing on, is it China or is it US? Or because if anything, it's the China that's not that believable anymore, but maybe you could believe the US. I think it's all a bunch of bollocks anyway, but it's like what people decide, right? And I think what we want to see the actual evidence, and the actual evidence is the refinery margin being stronger. Whereas Q4 margins still look pretty weak, right? Can't see the data right now unless you want to get it up, but that was where we were focusing before. We said they're dipping into like essentially negative territory once you align for costs.
Yeah.
Well,
I mean, like M1 like being strong like has kind of like lifted the whole curve up a little bit.
But then you can actually spur spot demand. Like a lot of in the CFD market, in the data Brent market, the CFDs, there is like just general hedging flow in the prompt from refiners. They tend to buy the 1 week, you know, so let's say it's May, so they'll buy like back end of May versus the full month June. So they buy the back end to hedge the purchasing of crude, sell the full month June, because that matches with the refinery crack, the product crack they're going to sell.
Right.
So you see that quite a lot anyway, but opportunistically it picks up when the refinery margins in the prompt have a rally, and especially if it's driven by the light ends, right? So NAFTA's had an awful time, but gasoline is driving things. That should help grades like Ecofis and WTI Midland that's coming in and setting the curve.
Yeah.
So if there's suddenly been this boost in refinery margins in the prompt, it will transpire into genuine buy-side hedging flows from refiners, which in turn should support Brent spread, should support the whole Brent structure, which would help sentiment for flat price. So even though it is looking a bit on the weaker side lately, you know, things can turn.
It's a good opportunity.
Well, yeah, it seems that way. So I guess if we see the evidence of the hedging, I think the problem is that, you know, there's all these relationships before WTI Midland came into the complex that people just aren't as sure about. So it makes sense that there's low liquidity, and the relationship between the future spreads, the time spreads in Brent versus the DFL, the dated Brent contract, like that relationship's really important. And it's at levels that we don't usually see. Yeah. So data to lead being, you know, on the high side, essentially, it's not usually the case, because it should usually account for, you know, people buying barrels through expiry, selling it through data. Too complicated to get into now, but basically that is as you say, is another opportunity, because if liquidity is thin, then one big flow should move the market.
Yeah, I was gonna say, like, I think the indicator that like really helps, and like something that people need to like keep a close eye on, is the liquidity and how the open interest is changing in these CFDs, and also the front dated front DFLs and etc. Are we seeing like evidence of like new interest coming in or not? And then breaking it down to see like how people are positioning. That could be like a really, really good indicator that like the market is now healthy. There's genuine buying in the North Sea, and also this is supported by the stronger cracks. So liquidity and just like watching liquidity indicators could be very, very important over the next 2 weeks.
Yeah. So basically, whoever moves, the bulls or the bears, whoever moves strongly next will move the market because of the liquidity being thin. That's it in a nutshell, right?
Exactly.
Yeah, no, it's okay. Interesting stuff. So, I mean, just again, Audrey, on the, you did mention it about the discussion with India and the EU. Mm-hmm. Call it discussion. Looks like an argument. They're trying to stop them selling Russian oil back into the EU. But I just India said check your own regulations and all that. But yeah, it is just such an easy thing to say. Like,
yeah, if they're actually going to do anything about it is another thing.
But the way it's coming into Europe though is via the products, right?
Yeah, exactly. And also, we were talking to the trader on the desk yesterday that it's all well and good to ban the crude oil coming in because you can test that and you can know if it's Russian oil because of the specs. But if they blend it and produce, like make products from it, it becomes far, far more difficult to know if this is Russian origin diesel or if it's from somewhere else in the world because of the blended specs there. It's going to be so hard to test. So how do you clamp down on it? So it's very easy to just
nanobots.
Say, AI somehow will figure it out, but it's very hard to do. So it's just you can urge the government to please don't send us Russian diesel. We don't want it. But at the end of the day, Europe's going to. But it's not.
I'm reading it now. It's like India can buy this oil much cheaper. But if they use that in order to be a center where Russian oil is being refined and byproducts are being sold to us, we have to act. What are you going to do? Like, it's just such a silly statement. It's like typical arrogant EU. Like if they're selling into an open global market, a global system, if you meet the specifications, you send it wherever the best price is, right? Yeah. That's what refineries' job is to do. And who knows how, they might be buying some Russian oil. They're not exclusively buying Russian oil. There's a lot of work to be done to produce these products, right?
Russia still have to sell it at a discount to India, or India aren't going to buy it. So it's already hitting them really financially. So it reminds me of a time where I think David Cameron was saying, there's a new oil field that they're giving license to. This is obviously a long time ago. And it should lead to lower gasoline prices in the UK. And the BP were like, no. Like, it's part of a closed. It's a global system, the gasoline market. All that's going to happen is there might be more oil coming from the North Sea. Mm-hmm. That will be refined by European refiners, and the gasoline will be sent wherever is the best price. It's not going to reduce the UK's price at all necessarily. Mm-hmm. And that kind of like lack of understanding, it's fine if you're not a specialist, but to make a statement like that, we need to act because you're refining Russian oil and selling it to us. It's like, it's not. It's just they're selling it wherever the demand is.
That's about everything in a globalized world, isn't it? Like,
exactly.
Any product, if you produce it, you're gonna look at the arbitrage levels and see where is looking best to sell your product. But and it's the same case for
gas as well.
For gasoline specifically, we saw, I think a couple of podcasts ago, we were saying that the export out of Russia has peaked into the exports into African countries has peaked for gasoline and diesel. So it doesn't necessarily have to be Europe. It might go to Africa first. I don't know, get there, get a better, they get a better market share there. And then European products can stay in Europe instead of going to Africa. So in a way, as the theme of the last discussions that we had, it generally feels like the routes for exports have become a lot more optimized. the flow seems to be geographically making a lot more sense for Russian products. So it doesn't have to come to Europe. It could be just a case of
and it isn't just India anyway. Like all the stories of LNG cargoes being like literally bought from China by China, and they weren't even refining it. They were just selling it back to Europe. So, you know, going out and putting the finger at one country when there's another country doing exactly the same thing, and it's just all trading at the end of the day. Like it's just trying to control the whole world again, and it's just yeah, that's not how the oil market works. But yeah, at the end of the day, we're looking at it from a sentiment point of view, and it won't have any impact because, you know, I guess we're looking at binary things when it comes to the derivative market. It might have an impact on the physical, but for the derivative market, do the derivative participants actually believe this has any net impact, or even the product markets, but certainly not Brent crude futures, right? Its sanctions are just not really considered anymore in terms of the actual pool of oil in the world. This is all regulatory side of things and governments. In terms of the world's oil flows, all they've done is reshapen, right? The balance of oil is hasn't really changed. And I think that's the consensus, and that therefore any news on sanctions, I guess, doesn't really have any impact. I mean, and there's certainly this headline won't support things, unless you could argue that, you know, if you're short gas oil and you're losing money, it's a typical thing a risk manager would question, right? I've seen this news, you're short, you're losing money. Have you considered the Russian sanctions or whatever story people want to attach to it? It can lead them to buy. So it's all in the eye of the beholder, right?
Yeah.
But I don't think it's like, it might be used as a story for why gas oil starts to rally now if there's short covering, but I wouldn't say that's...
I mean, it didn't, like, prices did move up in spreads and cracks, but not super significantly. So it's just, maybe it just coincided with shorts, you know.
But you know how it happens though, right? So shorts stop out, market starts rallying.
And then this news headline
and
comes
then there's
out,
a fundamental
it's like, well, this is what drove it. Yeah.
Exactly.
Yeah.
So that, I mean, unlikely, but just to cover the topic, I guess.
Yeah. Yeah.
And anything else on the oil front?
It was more LNG. I mean,
Ehsan had gas,
Ehsan had some interesting weather update. Okay. Have a weather segment.
Oh right, yeah.
In weather this week.
Yeah, that was quite interesting.
Yeah.
I'll just probably put it on the screen for everyone to see. So what we're looking at for the listeners, we're looking at the over the last 80 years, how the El Nino and La Nino years have like evolved, and you know, generally speaking, La Nino years means that like in Europe and US you have warmer weather, and El Nino years are generally meaning that like you have wetter and more frosty weather in climate in Europe and the US. So over the last 3-4 years, one thing that is interesting is that like the fact that the amplitude of the temperature change has definitely been on the increase over the last 80 years. But what we had is over the last 3-4 years, we had La Nina years, which means like you had like warmer weather. But now the forecasters are telling us that we are moving towards like having a El Nino year, which means that you're going to have like colder weather in Europe and US in the winter months. And circling this back to the market, the weakness in the LNG benchmarks, TTF
And gas, TTF.
TTF trading below 30. There's one interesting fact, and also the JKM versus TTF, the basis, had a really large swing in prices, especially in Q3. Again, I'll try to like share this on the screen.
But this comes in, Audrey, right? When we were saying a while ago, like if you're going to get lazily short, gas oil is one thing, but gas as well.
Yeah, especially because this is very dominated by physical, because you can only have, so even if your storage, if you fill storage in summer to 100%, that's still only a certain amount of storage. And if you start bombing through that in the winter because it's cold, it now becomes, well, how do you fill it back up again? Yeah, because last winter was like storage came down very slowly because it was so warm. But you know, if this winter is exceptionally cold, you do have only a certain amount now in storage, how do you then start filling that again? And that's where the problems are going to start coming in if this happens. Obviously, you're going to see Asia coming back as well on the spot market, likely, as their demand picks up.
So it's like recency bias.
Yeah, I think everyone's like, oh no, last winter was so mild, we're so fine, and we're going to fill storage and it's going to be great. We're going to have 100% storage. But you don't actually have that much storage. You don't have unlimited
infrastructure
storage.
isn't there.
It's not there. Yeah, I mean,
it's the EU have woken up, right? They are building a lot of infrastructure.
But it's a long-term thing. It's going to take like 5 to 10 years for it
and the
to
restructuring of LNG flows. I know what you mean. I can't see it being as big of a shock as last time.
Yeah, I mean, obviously you've got Freeport as well this time around, whereas last summer that was offline from June. So we've got that this summer.
Explain that.
The Freeport LNG, the explosion that happened back in June. So you had all the flows there from the US coming into Europe, were obviously a lot more, were significantly reduced because of that. So that's obviously back up online. And then
so a lot of the reason why LNG cargoes couldn't come from the US is because
this facility, there was just reduced flows. Yeah, it was just offline. It was just completely offline because of the explosion. But that's back online now, and they're actually even upping their production. And also you've seen like Germany are building like offshore storage for LNG. Like just ships. So that's
not a new thing in terms of like responding to the US changes in production. So the petrochemical plants, storage facilities as well, and the UK even were built to take on like all this new flow that was coming from the US and like NGLs and these kind of things. Like they build them very quickly, respond very quickly. Like nothing's better than a economic incentive, right? And they're buying a hell of a lot of cheap gas as the US started to have this boom in gas production. So I think you've seen it with the US crude exports as well. 1 million barrels a day, 2 million barrels a day was the staple. Another 5 million barrels per day, and they're going to keep growing. Yeah. So you can see the LNG response as well, is what I'm saying.
Also Asia, I mean, if the prices for gas just get too high, they're happy to switch to coal and nuclear. Where like the EU is not willing to that. Asia, like in general, they're happy to go and switch to coal and nuclear if the price isn't right for gas. But Europe. Not so.
But back to your point. But isn't this like kind of like a forced decision? Because now, we didn't expect that there's going to be like a war in Europe, and that happened. So there was a cutoff to supply into Europe, and that was kind of forced onto Europe that you need to build more LNG storage capacity. But then we kind of at a crossroad for other energy resources as well, like you got like hydrogen fuel, solar panels, all these other things. So are you going to invest a lot of capital now to build a lot of LNG storage while you're at a crossroad and like things might change in the next, 10, 15, 20 years? How much can you justify, and how much is enough in terms of storage for the future plans that you have? Especially with these things, it seems to be like a strategic thing that like, you've got to think about way ahead of time. But Europe seems to be like this time very much forced into do something rather than strategically planning on like making more storage. So I guess what I'm trying to say is this capital that is being spent on the storage going to be paying back over the next 20 years, or are we just going to spend this to just like at the moment as an emergency thing to be able to provide energy to the households and to the whole population in Europe? But I guess the long-term thing is having a more robust flow of LNG, using LNG carriers across the globe, right? Getting things into the sea, and like just like oil, that's like you have like a really, it's a very mature market in terms of like having global routes for things to move around.
So what are you saying? You're saying that they spend all this money to get new storage facilities to allow LNG flows to account for the redirection of trade flows to get it into Europe. That's what, you're saying, is that capital going to be?
Yeah, I'm saying like the capital that they're going to spend on storage, is that gonna always be used up over the next few years? Right. Are we gonna like really capitalize on that, or get the return that we need on the investment that we're putting? Or is it better to invest in the LNG carriers themselves, and then like have a lot more robust flow of like LNG over the globe rather than having like storages in different places.
But either way, you're going to need the traders to deliver the LNG into somewhere, right? Into these storage facilities. And you're saying you want it.
Well, what I'm saying is like if the flow is optimized, then you can get like good flow in. With the current capacity that we have in Europe, you can still, power the households and then use the LNG that you need for power generation, etc. It's just a matter of, making this market more mature.
Okay. Getting more used to LNG as the
exactly
as opposed to pipeline gas.
Yeah, exactly.
No, I can see that argument for sure. But that I would argue that is happening. I mean, it was almost lucky in a way because the LNG investment had been huge, and that's why we set up a while back, because it was more that the trade houses and majors were making it very clear that in the last 10 years they put a lot of money into LNG, and so all the development was happening anyway. Yep. But so I guess it's just encouraging that shift because there's more optionality, basically. Yeah,
that brings back to our activity as well. Like us as on the trading side as market makers, we play like a crucial role in bringing in liquidity into this and making these contracts more active. Especially in Q1, it was a really, really dead market, but now it seems to be the time that things are moving because the prices are moving and like players are becoming more proactive than reactive.
Hedge arbitrage flows, things like that. Yeah, and we need more contracts as well, because if you're going to be buying from different areas around the world, there's only really the JKM LNG contract, which is the Eastern contract. There's nothing in Europe that's really gotten traction, or the US. So that needs to develop, and I 100% agree. So I mean that's pretty interesting. If covered quite a lot. I mean, is there anything else you want to bring up, or?
Well, there was just
Audrey's got something.
I've got something interesting, just because it links up a little bit to what we were talking about a couple of podcasts ago when we were talking about Just Stop Oil. Okay. So I was going for very low hanging. I was going good for some very low.
They were outside our office the other week. I don't think they need it.
We were here.
Yeah, we were here.
I thought I saw Greg's face on a banner though.
Right.
No, it's okay. I was looking. I just literally Googled oil news this morning, and the first headline that comes up is, "Will Shell ruin their future?" And what's going on at Shell. So me being attracted by the clickbait, clicked on it, and really interesting. It's actually just people being encouraged to buy shares in big oil companies, which is a really big step forward. I mean, obviously we were talking about, I was definitely giving in about how these kind of these groups like Just Stop Oil come along and have a problem but no solution. But this is a really good step forward in actually finding a solution. So you can actually scroll down to the bottom and you can see you can buy shares in Shell, BP, Total, Exxon, Chevron. Basically the idea being that if you really want to drive this green movement, that it does need to be these big companies. You need to get on board and cooperate with these.
So what happened?
A bit counterintuitive.
Say this again, sorry, in a nutshell.
Sorry about Shell.
Just Stop Oil have encouraged.
No, it's not Just Stop Oil. I'm just saying that this is a new group. I think they're called Follow This.
Oh, sorry. Okay.
Yeah. It's called become a like a green shareholder, and just getting involved in the big oil companies.
In these big companies, yeah. So basically, the idea being that I'm sure if you buy a 60 quid share in a company, you're not going to get much of a say. But if enough people do it, majority sharebholders now become eco warriors.
Yeah, it's quite interesting. It's got a donate button as well. Like you can either donate or buy a share.
To these big multi-billion corporations if you want. It's a really good idea. This is definitely a big step forward.
So you're saying that if this is going to gain traction, then the major oil companies need to demonstrate how they'll use that money towards. Yeah,
so the idea being that, if enough people that are shareholders in the company, have like an agenda that's a lot greener, that they can push these big companies, these like multi-billion corporation companies to do.
So it's like a bear hug for control on the board to be green.
Yeah.
Cool.
But I just think it's a nice kind of tie-in with what we were talking about the other day, that because we were obviously speaking about, who's going to be the best people to, really power on with this green revolution. It probably is the companies that you don't want to admit, like your BPs, your Shells, your big oil majors, and it's good to see the step forward where people now are being encouraged to get involved with these companies, cooperate with these companies, and have their say rather than just
political pressure that way, rather than just
talking at them in the news and standing outside with a sign.
Oh, that's great. That's great.
It's really interesting. I just thought it tied in really nicely with that podcast that we spoke about the last day.
Cool.
So really interesting. If for anybody that wants to find it, just Google oil news and it pops up.
I'm sure you'll bring up Just Stop Oil next week as well, so you can talk about
running theme.
All right, cool.
Guess next time.
We'll leave it there.
Yes. I wanted to talk about petrochemicals, but like I'll leave that for next time. Just a bit of a teaser.
Okay.
I'll just leave that for next time.
In a word, what about petrochemicals?
I mean, generally, like the outlook for the market over the next 10 years,
Actually,
15 years.
That is an interesting one for next time. Yeah, with plastic, and that's another side of the climate discussion.
It is.
I'll use another buzzword: 3D printing.
Oh,
I'm going to talk about that. Yeah.
If you put AI in, I think you've got
AI 3D printing.
Nice. All right.
Yeah.
Thanks, guys, and thanks out there for listening, and hopefully tune in next week and see you then.